You know that sinking feeling when a car breaks down at the worst time and you instantly think, how am I supposed to get a loan with my credit score? What if getting a car loan with bad credit was not as impossible as it seems? And what if there were a few simple steps most people never hear about that could save them thousands of dollars? Stay with me because in a minute you will discover the part of this process that almost everyone gets wrong, and fixing it could completely change your approval odds. Number 1. Why bad credit does not mean no car loan. Most people panic when they see their credit scores in the low 500s or 600s. They assume no lender will ever approve them, but that is not true at all. In the USA, millions of people get approved for auto loans every year with less than perfect credit. In fact, research from Experian shows that nearly 1/3 of car loans go to people with subprime or deep subprime credit. That means borrowers with scores below 600 are still getting approved every single day. The real deciding factor is not just your score, it is your stability. Lenders look at how long you have been at your job, how much you earn each month, and how predictable your income is. Imagine two people. One has a 580 score but earns a steady income working for the same company for 3 years. The other has a 630 score but changes jobs every few months. The first person might be approved faster and get better terms because lenders value reliability. This is why you should not quit before you start. Bad credit does not block you, it just changes how you approach the process. Number 2. The biggest mistake people with bad credit make. If you only remember one thing from this video, let it be this. Never walk into a dealership without knowing your credit report. Dealerships love when buyers have no idea what is on their report because it gives them full control. They can tell you anything and you might believe it. For example, someone might have an old medical bill that went into collections. It may not actually be hurting their score anymore, but the dealership might claim it makes them a high risk and raise the interest rate. Another example is when someone has 2 old accounts that were closed but still show a balance. These mistakes are extremely common. The Consumer Financial Protection Bureau reports that around 1 in 5 credit reports contain an error. If you do not know what is on your report, you cannot protect yourself. Pull your own credit report first. It's free once every year from the major credit bureaus. When you know exactly what lenders will see, you walk in with confidence. Number 3. How to prep your credit for a better loan.
Most people think raising their credit score takes months or years, but the truth is that even small changes can boost your score within weeks. One of the fastest ways is to reduce your credit utilization. If your credit cards are maxed out, paying them down even a little can make a difference. For example, if your card limit is $1,000 and you're using $900, lowering it to $500 can significantly raise your score. Another trick is asking for a credit limit increase. You do not need to use the extra credit, but the higher limit lowers your utilization, which can help your score. You can also dispute old errors. Say you had a late payment that was reported even though you paid on time. Fixing that one error might give your score a boost. Every bit counts when you are trying to qualify for a loan. This preparation gives you leverage. The better your score, even by a few points, the more negotiating power you have. Number 4. Understanding the income requirements. One of the questions beginners ask the most is, how much do I need to earn to get approved? Lenders usually want to see steady monthly income. Many subprime lenders want at least $1,500 to $2,000 in monthly take-home pay. But this is flexible. An example, a single parent working part-time and earning $1,600 per month might still get approved if they've been at their job for 2 years and have no recent defaults. On the other hand, someone earning $3,000 per month but switching jobs every 3 months may struggle. Lenders also look at your debt-to-income ratio. If most of your monthly income already goes toward bills, they worry you cannot afford another payment. This is why reducing your current debt before applying can improve your chances. The key idea is this: you do not need high income, you need stable income. Number 5. Why down payments matter for bad credit borrowers. If your credit is low, your down payment becomes your strongest weapon. A larger down payment lowers the lender's risk. It also lowers your monthly payment and the total interest you pay. Even a small down payment can make a difference. Take this example. Someone buying a $6,000 used car with zero down might face a very high interest rate. But if they put down $1,000, the lender sees them as more committed. That could lower the interest rate or improve the loan terms. Another example, a buyer with a 550 credit score might get rejected at first, but with a higher down payment, suddenly approval becomes possible. Think of your down payment as your safety net. The bigger it is, the stronger your position becomes. Number 6. Picking the right car makes or breaks your approval. This is something beginners often overlook. Your approval depends heavily on the type of car you choose. Lenders want to finance reliable, lower-risk vehicles. They prefer cars that hold value longer. That means they often approve used cars more easily than luxury or specialty models. For example, a modest Honda Civic or a Toyota Corolla is much easier to finance than a sports car or a large truck. Even if both cost the same amount, the lender sees the first one as safer because it is more dependable and costs less to repair. Here's the trick. Choose a car that lenders already like. The easier you make it for them, the faster you get approved. Number 7. Get pre-approved before talking to a dealer. If you want real power in this process, you need pre-approval. Pre-approval means a lender reviews your income, credit, and details before you visit a dealership. This gives you a number. It might say you qualify for up to $10,000 or $12,000. That number becomes your shield. Here's why. Dealerships cannot play games with you when you already have financing. They cannot inflate your rate or hide fees because you know your baseline. You can still choose to take the dealer's offer if it is better, but you are not forced into anything. Imagine two buyers. One walks in hoping for a miracle. The other walks in with a pre-approval letter. Guess who the dealership takes more seriously? That second person. Pre-approval puts you in control. Number 8. How to compare loan offers like a pro. Comparing loans can be confusing, but it becomes simple when you focus on 3 things: the interest rate, the total cost of the loan, and the loan term. For example, you might see 2 offers. One has a lower interest rate but a longer loan term. The other has a slightly higher rate but is spread over fewer months. The second one may cost you less overall, even with the higher interest rate. Another beginner mistake is focusing only on monthly payments. Low monthly payments are tempting, but they often mean paying more in interest over time. A clear example: a car loan stretched to 7 years might lower your monthly payments, but cost thousands more in interest. Meanwhile, a shorter 4-year loan might be tougher month to month, but cheaper in the end. Compare the total cost, not just the monthly number. Number 9. Avoid the traps that target bad credit borrowers. Unfortunately, some lenders take advantage of people with bad credit. They offer loans with extremely high interest rates or hidden fees. These are called predatory loans. They look helpful on the surface, but are designed to make you overpay. One example is a lender offering a car loan with interest rates close to 30%. Another example is a loan that includes unnecessary extras like extended warranties or overpriced insurance rolled into the loan without your clear permission. How do you protect yourself? Read the loan agreement carefully. Look for the total cost of the loan. If something seems unclear, ask questions. And if the deal feels wrong, walk away. There are always other options. Number 10. Build future credit while you drive. Here is the best part. A car loan can actually help rebuild your credit if you make your payments on time. Payment history makes up the largest part of your credit score. That means every single payment you make becomes a building block for your future. For example, someone with a 520 score might get an auto loan with high interest, but after 12 months of on-time payments, their score could rise significantly.
That puts them in a much better position when they refinance or apply for future loans. Another example. Someone who had a bankruptcy might feel they will never recover, but consistent payments on a car loan can prove to lenders that they're responsible again. A car loan is not just transportation, it is a credit rebuilding tool. Number 11. The step-by-step game plan to get approved. Here's the moment you've been waiting for, the complete beginner-friendly roadmap you can follow starting today. Step 1. Check your credit report. Know what lenders will see. Step 2. Improve your score as much as you can in the next 30 days. Pay down small balances. Fix errors.
Step 3. Gather your income documents, pay stubs, bank statements, and proof of employment. Step 4. Save a down payment. Even a few $100s helps. Step 5. Choose a reliable car that lenders prefer. Step 6. Apply for pre-approval with a trusted lender. Step 7. Bring your pre-approval to the dealership, compare offers, and choose the best deal. This step-by-step plan works because it puts you in the driver's seat, literally and financially. Number 12. How the type of lender changes everything. Not all lenders are the same, and picking the right one is one of the smartest moves you can make. There are banks, credit unions, online lenders, buy here, pay here dealers, and special finance departments. Each one treats bad credit differently. For example, a big national bank might deny someone with a 560 credit score instantly, but a local credit union might approve them because credit unions often use more flexible rules. Another example is online lenders. Some specialize in helping borrowers with low credit, but they may charge higher interest. And then there are buy here, pay here lots. They approve almost anyone, but the interest can be extremely high. The right lender can save you thousands of dollars over the life of the loan. This is why you never rely on only one lender. Compare them, because different lenders mean different opportunities. Number 13. Using a cosigner the right way.
Many people with bad credit never consider a cosigner because they think it is embarrassing or complicated. But the truth is that a strong cosigner can completely transform your loan terms. A cosigner with good credit lowers the lender's risk, and that often leads to better approval odds, lower interest, and smaller monthly payments. For example, someone with a 520 score might face a loan with extremely high interest, but if their parent or close relative with a 700 score cosigns, the rate could drop dramatically. Another example, a young worker who has limited credit history but has steady income might use a cosigner to unlock better loan options. However, cosigning is serious. If you miss a payment, the lender will report it on both credit reports, so you use a cosigner only when you know you can make payments on time. Number 14. Why car age and mileage affect your approval. Many beginners do not realize lenders prefer cars that meet certain age and mileage limits. When a car has high miles or is too old, lenders fear expensive repairs. That makes it riskier to finance. For example, some lenders do not finance cars older than 10 years. Others may avoid cars with over 150,000 miles. A 2015 Toyota with 90,000 miles is usually easier to finance than a 2008 luxury car with 170,000 miles, even if the luxury car looks nicer. If you want easier approval, choose a car that fits lender guidelines. The car you select is part of your financial strategy. Number 15. Why loan term length affects your total cost. The length of your loan is a major decision. Beginners often choose long loan terms because the monthly payment looks cheaper, but long terms usually mean paying more in interest. For example, choosing a 72-month loan instead of a 48-month loan may reduce your monthly payment, but the total interest could be thousands of dollars more. Another example, a shorter term might feel harder each month, but it builds equity faster and reduces your financial risk.
The right loan term is not just about comfort, it is about long-term cost. Number 16. The power of making one extra payment every year. This simple trick can save you a surprising amount of money. If you make just one extra full payment each year, you shorten your loan term and reduce how much interest you pay. That works even if your credit is bad. For example, if your monthly payment is $300, paying an extra $300 once a year might cut months off your loan. A single bonus check or tax refund can make a difference. Another example, someone who makes an extra payment every 6 months could save even more. Small changes stack up over time. This is how responsible borrowers with bad credit rebuild their financial life. Number 17. Why refinancing later can save you money.
If you get a car loan with bad credit, you are not stuck with it forever. As you make payments on time, your credit score improves. And when your score goes up, refinancing becomes an option. For example, someone who starts with a 24% interest loan might refinance a year later at 14%. That change alone can save them thousands of dollars. Another example, a borrower who makes consistent payments and lowers their credit utilization may qualify for a refinance that reduces both their monthly payment and total interest. Refinancing is a powerful tool for people rebuilding their credit. Number 18, how to spot a fair interest rate for your score. You never want to accept the first interest rate someone offers you. Instead, compare your score with average rates. Research shows that people with poor credit often get rates between 16% and 28%, but that does not mean you should automatically accept the high end of that range. For example, if your score is in the mid-500s and a lender offers you 27%, that might be too high compared to similar borrowers. Another lender might offer 21%, which is still high, but significantly better. You do not need the lowest possible rate. You just need a fair one. Number 19. The secret advantage of buying from a private seller. Most people think they must get financing through a dealership, but you can often find cheaper cars from private sellers, and the loan amount you need could be much smaller, making approval easier. For example, instead of financing a $10,000 dealership car, you might find a reliable $7,000 car from a private seller. A smaller loan is easier to approve and lenders take on less risk. Another example, some lenders offer personal auto loans specifically for private party purchases. These loans can be more flexible than dealership financing. Buying from a private seller can be a smart strategy when your credit is low. Number 20, how to know if you are being overcharged. When you have bad credit, some dealers assume you won't notice extra fees. They might add document fees, prep fees, inspection fees, or unnecessary add-ons. These fees can quietly increase your loan. For example, someone might agree to a loan expecting a monthly payment of $300, only to discover hidden fees pushed it to $330. Another example is when dealerships roll in expensive products like gap insurance without explaining the real cost. To protect yourself, read the contract line by line. If something looks wrong, ask. Awareness is your biggest protection. Life gets a lot easier when you can drive where you need to go without worrying that your credit score is holding you back. The real question is, which part of the car loan process confuses you the most?